In financial markets, the price of a security is supposed to be a signal, a distilled expression of all known information about future cash flows, growth expectations, and risk premia. It is a snapshot of consensus, a balancing point between bulls and bears. But markets are not laboratories. They are not populated by idealized rational agents acting in a vacuum. Instead, they are living ecosystems of influence, feedback, and narrative. Great investors understand this duality. They know how to extract information from prices, but they also recognize when prices stop reflecting fundamentals and begin shaping them. This video explores how savvy investors distinguish between information and influence, drawing on classical theory, modern case studies, and the psychology of herd behavior. The goal is to highlight how separating these two forces can give investors a critical edge. In microeconomics, the equilibrium price is revered. It is the point at which supply and demand balance, efficiently allocating resources. In capital markets, price serves a similar function. It aggregates expectations about future performance, discounting risks and opportunities into a single observable variable. When functioning properly, prices provide tremendous informational value. Arbitrageurs serve a vital role in reinforcing this function. When prices deviate from fundamental value, they step in, buying low and selling high, forcing convergence. This is negative feedback, self-correcting behavior that brings the market back to equilibrium. But in real-world markets, this negative feedback loop can be overwhelmed. Prices can become self-reinforcing rather than self-correcting. In these moments, prices are no longer informative, they are influential. And when influence takes over, rational analysis can get drowned out by emotion, mimicry, and momentum. The most dangerous markets are not those driven by ignorance, but by imitation. Investors don't need to believe in a thesis themselves. They just need to believe that others will continue to act on it. This creates a cascade. The rise in price becomes the justification for buying, not the other way around. Mark Granovetter's threshold model explains this well. Imagine each investor has a threshold for action based on how many others are doing the same. One buyer triggers another, then another, until a tipping point is reached. The result is a market that moves not on new information, but on social contagion. Once price becomes a source of influence, it stops conveying useful information. The signal is corrupted. Momentum takes hold and narrative takes precedence over valuation. We've seen this type of idea play out on the markets a number of times. Here are a few examples. Perhaps the most vivid modern example of influence overtaking information was the GameStop short squeeze of early 2021. What began as a contrarian thesis on Reddit's Are Wall Street Bets morphed into a populist movement. As prices soared, driven by gamma squeezes and coordinated buying, investors piled in, not because of any revised expectation about GameStop's future cash flows, but because price action itself demanded attention. Traditional valuation models were not just irrelevant, they were ridiculed. The narrative became the investment. Cathie Wood's ARK Innovation ETF, ARKK, surged more than 150% in 2020. The underlying strategy was based on innovation-led disruption, but the inflows increasingly became reflexive. As ARKK's price rose, more investors bought in, driving it even higher. The fund size ballooned, and the stocks it owned rose, partially because ARKK was buying them. By late 2021, many of ARKK's top holdings were trading at valuations that embedded flawless execution for a decade or more. When interest rates rose and sentiment turned, the feedback loop reversed, and influence unwound rapidly. NVIDIA's meteoric rise in 2023-2024 on the back of the generative AI boom exemplifies the challenge of separating information from influence. Yes, the fundamentals were strong. Data center demand, GPU dominance, and AI optimism were real. But the degree of valuation expansion, forward PE ratios north of 70, market cap increases of $500 billion in months, prompted questions. Were investors buying NVIDIA because of updated detailed analysis of long-term cash flows? Or were they responding to momentum, media attention, and institutional FOMO? Humans are deeply social creatures. In markets, this manifests in a tendency to conform, to fear being left behind, to mistake movement for meaning. Professional dynamics further compound this social wiring. Many fund managers care not just about being right, but about not being wrong alone. This is the essence of Keynes's famous observation. It is better for reputation to fail conventionally than to succeed unconventionally. Separating from the herd is psychologically and professionally difficult. But great investors cultivate a mindset that is comfortable with discomfort. They develop a tolerance for being out of sync. This doesn't mean reflexively going against the crowd, but being willing to stay out when the crowd is clearly not anchored in fundamentals. So how do great investors do it? Reverse engineering expectations. Tools like reverse DCFs allow investors to backsolve what assumptions are embedded in the current price. If those assumptions seem extreme, the price may be more influence than information. Scenario analysis. Great investors map multiple outcomes and stress test the plausibility of each rather than following single narrative thinking. Narrative filtering. They ask whether the prevailing story, AI, disruption, short squeeze, is being used to justify price action or to explain business fundamentals. Mental models. Investors like Howard Marks or Michael Mauboussin talk about second-level thinking. Great investors operate on this level, understanding how others are likely to react and what that implies for price distortion. Some argue that influence itself is a kind of information. Momentum investing, after all, is based on the premise that trends persist. George Soros' theory of reflexivity suggests that fundamentals and perceptions co-evolve. In this view, rising prices can create improved fundamentals by lowering a firm's cost of capital or increasing talent attraction. There's truth here. Influence is not always irrational, but great investors recognize when reflexivity is temporary and unsustainable. They profit from it perhaps, but they also prepare for the reversal. For the working analyst or portfolio manager, the key to resisting social contagion lies in building thoughtful, deliberate systems that act as guardrails against crowd-driven behavior. First, process discipline is essential. One of the most powerful questions an investor can ask is, what would I believe if I didn't know the stock price? This simple exercise strips away the influence of market momentum and refocuses analysis on fundamentals. Alongside this, maintaining a rolling set of valuation anchors, independent of market moves, helps investors ground their views in intrinsic value rather than sentiment. Equally important is the culture within investment teams. The best performing groups foster an environment where dissent is not just tolerated, but actively encouraged. In these cultures, fear of missing out is recognized as a psychological trap, not a rationale for action. Finally, when influence-driven narratives begin to dominate, it's prudent to deploy risk tools that hedge thematic exposure. Whether through options, pair trades, or sizing adjustments, these tools provide a buffer against the volatility that often follows periods of speculative excess. The markets will always be social arenas. Influence will always bleed into price. But the best investors are those who can listen past the noise, who can look at a euphoric chart and say, that's interesting, but is it justified? Separating information from influence is not just an analytical task, it's an emotional and cultural one. It requires courage, independence, and clarity of thought. When everyone is chasing the same story, the great investor is writing their own.